I've just been watching, I was watching this LinkedIn stock trading. This kind of brought back memories of the day. It'll be interesting to see what happens into the close with that stock. But yeah, it's the only thing you can do with it if you're trading it is buy it long and sell it. You can't short it. You can't do options on it. You can't do verticals on it. I'm curious though, since this is live, I'm going to throw a squeeze on here. I've got my iPod on shuffle in the background. It's not playing a good song right now. Let's see, what was, oh yeah. So usually this is how, this is how we did these back in the late 90s too. So you can see something like this, where, you get this little movement here, you get some consolidation, boom. You can use the squeeze as a trigger. And it's kind of tricky as to exactly when to get out, but typically there's like one big flush move like this. And it's very difficult to get out on the way down. So you got to like kind of scale out, and then you just kind of wait for squeezes, and things typically then quiet down until about the last hour or so. Some idiot though, chased and bought it here at 122. And I use the term idiot kindly because I've done that before. But if it walks like a duck and quacks like a duck, you got to be fair and call it a duck. And yeah, so there's that. All right, so let's go back and look at some more pinning. So what are some ways you can find some pinning stocks? Well, these are the 226 stocks that I watch right now for options plays. So a lot of times what you can do, and I can give you guys a copy of these, or in fact I've copied and pasted these into the discussion forum. One thing you can do on this is just sort by volume, because essentially how pinning works is it works most effectively on the highest volume stocks that also trade the highest amount of options, right? So, if we come down here and look at what's trading the highest amount of volume, well, the spiders. And I saw a question earlier before break, do you do pins on the spiders? And the answer to that is I actually do not. I just like it more on individual stocks. Bank of America, you can see, I really need to change banks. Bank of America just keeps looking pretty crappy here. Let's go, I'm gonna look at Bank of America. Okay, good, I got that. 1 minute. Let's look at a 21 minute. Wow. Why am I still using that bank? I've actually never really done a pin on Bank of America, only because it's always such a low price stock. But let's take a look at it here. And I guess I can put this over. You guys can. Oh my goodness! Oh my goodness! Did I really just say oh my goodness? So check out the open interest on this. So you're talking like huge open interest here. So 190,000 contracts, 231,000 contracts, et cetera, et cetera. But you can see it's just trending down. There's no way in hell that it's going to bounce up to, $14 tomorrow. So, so the question is does it get pinned at 11 or 12? And 12 actually has a lot of open interest on the put side and the call side. But look at this. It's such a downtrend here that I don't even want to mess with it. So that is actually not an attractive play to me because all the high open interest is above the current market action, and you can see there's obviously a pretty decent downtrend here. So, and honestly, I'm not that familiar. I haven't done Bank of America enough to know how well it pins. So I'm going to pass on that one. And let's see, Intel. And what I'm doing here is I'm just going through those high volume stocks. Intel, let's take a look at that. So open interest at the $24 strike is quite high. It's kind of interesting. Let's kind of keep looking here. And what I'm doing here is I'm just kind of going through. Now, almost any of these stocks, the thing about it is the higher the volume, the better. So in reality, there's only about 15 stocks that I really look at, and we'll talk about those and kind of give you the, give you the list and everything like that. But you can see that I'm generally only interested in high volume stuff here. I'm not trying to do trades on the lower volume stocks or anything like that. So Target's actually a good one. I haven't done that one in a while, so let's look at that. You know, sometimes it's hard to forget. You know, it's easy to forget that there's other industries out there besides tech. All right, so Target, open interest, decent open interest. We're at $50.25. The $50 is 10,000. Yeah, so the $50 strike has the most open interest by far, and we're currently trading at $50.23. And you know, looking for a pin at 50. So really the question here is, okay, look at this here again. Is it worth it? And the $50 call is 40 cents. Oh, it's interesting. I didn't know it traded in singles. The $49 call. Let's look at that vertical. Okay, I'm gonna go back to the single. Yeah, so it's just not the problem is there's just not much room to work with. So the 49.50, it's 88 cents. Remember, it can go to $1, and how I'm determining that is, it's just, you know, if it was a $5 strike price, and the highest it can go is $5, right? So you're only talking about 13 cents of room to play with. So that's, you're kind of looking for, you know, if we went over here to Apple, and we looked at that 335, 340, you know, we're looking like at $1 of action to play with, right? So, you know, it's one of those things you kind of just have to go through and just kind of you're looking for that opportunity there. But let's look at Goldman Sachs. Goldman Sachs is another one that I like to do. Goldman's is at almost 140. All right, so we'll go here and look at the open interest. 4,000 or 3,000 at the 140. Wow, there's a lot more interest at the 145s. That's interesting. Let me look at Goldman Sachs here. I seriously doubt it's going to jump up $5 tomorrow. And so the setup that you're looking for is, so here's the $145 strike, right? And then here's the $140 strike. So even though, all right, and this is important, even though there's higher open interest up here, Goldman's has problems like SEC issues and stuff like that. And you can see there's obviously, I mean, look at the C wave. There's obviously downward pressure on the stock. So I'm not going to bet that we're going to get some huge, you know, $5 jump tomorrow, a $5 jump back up to this level just because the open interest up there is higher. You know, what you're looking at is more of a normal situation, and where I would be interested in that is, you know, if Goldman's was a little more mixed here and the price action, frankly, was more in the middle. And that's where I'm most attracted to these things, is when they're in the middle of two strikes. And sometimes the best days to do that is Wednesday. I prefer to do them on Thursday. And since we're just down here at 140 already, it really looks like this is going to be more something that's a pin at 140, and it's already there. So it's not as an attractive of a candidate, but it's something that we can watch. It's something that we can keep an eye on here. All right, so let me see what other ones here. Yeah, Gary. So, yes, ideally you want to find us one that's between two strike prices. So what I'm going to do real quick now is go through this list of stocks, and then we can kind of see you know, see which ones are kind of trading between some strikes. Yep. Oh yeah, there's no options on. It was an IPO. They never set a time, but it'll be like, it could be like a couple of weeks or even a couple of months. But yeah, there's usually never options on IPO day. Oh, I know. Yeah, but no. Okay, bye. Okay, that was somebody calling me going, hey, can we do options? Goldman should be out of business at the very least. I love shorting Goldman out of principle, but yeah, they're not going to go out of business. Oh, thank you. Somebody just typed in BIDU. That's like one of my favorite ones. Okay, let's look at BIDU. BIDU was pretty awesome for a while too because it had those single strikes. So what do we got? We're at 135, and the open interest there is 9,000 contracts. And okay, so 135 is clearly the winner for a strike price. The problem is that we're already at 135. However, the good news is look at the implied volatility on this thing. 30%. That's huge. So if we go to vertical here, and we look at the 130, 135. Okay, so we got about 80 cents of potential profit here. That's a good one. Thank you for bringing that up. So I like that one quite a bit. Let's come over here and look at the chart. Okay, now, here's the key with this. In fact, let's leg into this one. Now, once you understand the concept of this, what really gets cool is that you can leg into these suckers, okay? So far, I've just done them at the very, so there's 135 and 140. So what we can do here is watch this, and so what time is it? So it's 2 o'clock. So we can wait for a pullback here, and on the pullback, buy the calls, and then see if we pop back up into the close, and then sell the calls. And, okay, buy the 130s and then sell the 140s. Sorry, buy the 130, sell the 135. So let's let me see here. The night again, once you understand the stuff, you can start having a lot of fun with it. So we've got a pretty decent trend line coming up here, like this, and we're pulling back into it right now. We've gone from 136.30, and we're dropping like $1 here. All right, so let's take this opportunity. Let's step in. Let's step in and buy some of the $130 calls. Okay. Now, and if you look at the difference here, the $130 calls that expire tomorrow, okay, are $5.35. The $130 calls that expire next week are $6.65. So one thing you could do here is if you actually think that BID is going to go much higher, you could actually buy next week's. Okay, they're only $1 higher, or what's the June 130s? The June's are $8.95, and then sell the 135, which is kind of intriguing. But in this case, we're just going to do kind of a vertical here. So let's do, I just want to buy 10. And so where are we trading? So down here we're about, so we could go down another about 30 cents or so. So let's see if we can be a little patient. And by the way, what you do here is like delta's 90, right? So if it's going to go down 30 cents, then that'd be about a 20-cent change in the option. So let's go down to 510. And let's see if we can buy it there. So let's see what happens here. But so what I'm trying to do here, I'm getting a little cute, but it's with a plan. Again, the more you understand this stuff, the more you can play around with it. So instead of buying the vertical here, okay, and we could have bought it here too. I mean, it's actually just the one thing that's kind of nice when it's in the middle of the range there. But when we're looking at it, it's right here. We want to try to buy that pullback here, all right, and then later in the session, if we start to rally again, then we sell the 130. Then we sell the 135s. Okay. And that way we maximize the premium, the Ivy crush for tomorrow. And so right now you can see we're bid 520 by 530. All right, and we're trying to get them for $5.10. So obviously the ask has to drop to $5.10. Now I may get a little bit more aggressive here because we're actually close to that trend line, and we're holding. This is where you don't want to be a dick for a tick. And you still want to buy them even though the implied volatility is high. Yes, actually, that part's fine. And you can see we're still paying out. It's $135.17. So the premium is only 20 cents, Dave, that we're paying for. That's what I'm worried about. But look at the 135. Someone's paying $1.24, and that's all premium, which is awesome. So that's what we want. We want to capture that dollar. So if we could get these for $5.10, that would be a coup, because then that gives us more room. And we could actually do a ratio spread on this. A little bit more advanced, but I may do that. It's safer to do a vertical, meaning for you go 1-to-1. If you buy 2 contracts and you sell 2 contracts. Ratio spread is like for every 2 contracts, every 1 contract you buy, you could sell 2 or sell 3. It's trickier, but I wouldn't recommend it if you've never done it. Do it first in a demo account so you can see how you can get hurt. That's one good thing about a demo account and options is you can try different strategies and see how you get hurt, because you got to understand, it's like a relationship. You got to understand how you can get hurt. I'm not sure where that came from, but let's see. No demo accounts for relationships, though. Yeah, I think it's high school. That's what high school is for. Although not really. Not quite as the maturity levels in high school are not that high. My wife and I went and saw Bridesmaids last night. It was pretty hilarious. It's a chick flick, but it's like a hangover for chicks. But there are some scenes in there that are pretty hilarious. Well, so I'm just watching the stock here. So, all right. So I'm going to get a little bit more aggressive here because I do want to pick some of these up. So actually, I'm just gonna bid on some more here. All right, so let's come in here. Gosh, I really don't want to pay $5.45. Let's see if we can get. Let's see if we can get $5.35. What I'm doing is splitting the difference there. All right, so I got those instantly. So you can see what happened there is we were $5.25 bid by $5.45 offered. So I went in and said, all right, I'll give you $5.35. I got it instantly. That's why you never want to pay the ask. You can always typically split the difference. Now, I'm still going to leave my other order in there because I actually would like to buy it if it comes down. But what I want to do, and is if somebody can help me with this, because I'm sitting here and I'm doing a webinar, I'm going to be watching a lot of different things, is if BIDU pops up here and makes new highs on the day, let me know because I want to sell. I want to sell the 135s into that, okay? All right. All right, so that's BIDU, and let me see what else we got. You know, I've never done Lululemon. Let's see that. All right, so if I'm evaluating a stock, and this is a good example of that, if I'm evaluating something that I want to do, then what I'm going to do is I'm going to open it up exactly like I'm doing now, and I'm going to look at open interest. And you can see that the open interest isn't that great. Henry had a killer trade on this earlier in the month, doing options, and that was one of the questions he had on it. Is like, there's not much volume in the stock. It's okay if there's not much volume if you want to trade it, because that's the market maker's job, is they'll make a market. But for pinning, you got to have a high open interest, because if there's not a lot of open interest, then there's not a lot of incentive to pin that stock, right? So, and I've never done Lululemon, so we're not going to start today. That's something I'll just kind of keep an eye on. We can watch it tomorrow. All right, let's look at CMG. So open interest, we're at 280. Open interest is at 3,500 contracts. Yeah, see, it's just, again, nothing standing out. So that's the problem there. Plus, you got the $10 strikes that make it a little tricky. So you could buy the 280s at $2.80, and then sell the 290s for nothing. And then the 270s. What about the 270s? Yeah, so you just don't have much room to work with there, and that's part of what we're looking at, right? So nothing there. Kind of curious on Rackspace. I've never done a pin on that. Open interest isn't that great. What about, oh, not that one, CRM, Salesforce.com, which is a software we're currently using, or we're starting to use. All right, so this one is actually pretty interesting. So the 135s are at 7,000. The 140s are at 9,000. All right, this one could be interesting. All right, so again, easiest thing to do here to get a visual is just like, okay, draw a line where the strike prices are. Because remember, these stocks get attracted to these levels. Now, the nice thing here is we're pretty much dead in the middle between two strikes. Okay, this is actually a perfect example, okay? So what you're doing is you're trying to look at this and say, all right, we're right in the middle of two strikes. Are we going to this strike price, or are we going to this strike price, okay? First, we can look at the underlying trends. C waves above zero. You know, this has turned higher. So just on that alone, you've got more of a potential to go up there, right? But we also want to look at the open interest, because if the open interest is higher on the other one. So the 135 is 7,400 contracts. The 140 is 9,300 contracts. So the 140 is clearly higher. What about the put side? 2,000 contracts, 3,000 contracts, so it's kind of negligible. So yeah, so this is a good one. So now let's look at the 135. Am I looking at this right? All right. Now let's back up a little bit. Can somebody tell me, is there going to be an earnings report on this tomorrow? Because the implied volatility is 109%. The $140 call, which is out of the money, is selling at $3.10. That's insane. I mean, I almost think this is a misprint. So let's check. There's something going on here. I don't know what it is. I mean, that is insane. The $140 calls, I mean, unless I'm on crack and I'm reading this wrong, don't laugh. That's an insane price. Are there earnings? Can someone tell me? I'm going to look at this tomorrow. Okay, so that makes sense. Okay, so this is a really good example, guys, and we can still do this. So look at this. This is very, very important. So the implied volatility is 100%. Now, I didn't know that there were earnings tomorrow, but as soon as I saw that, I knew that there was something wrong with this picture, right? That's so unusual. So, well, this is interesting. So what I would do is just bet the farm here and buy calls. Okay, of course, that was a joke. Now, you can actually still do spreads before earnings. The problem is the attractive factor is that you know, $3 for the out of the money call is great pricing, and if you buy the spread and it goes higher after the close, you make the spread. If it goes lower, you're hosed. So yeah, okay. So there's a couple things you can do here. You can sell a strangle. This is going to be a little bit more for advanced, traders. I'd like to do this though, just as an example for tomorrow. What I'm trying to do mentally here is see if I can take both sides of this trade. And let's say I bought the 135.40 verticals to the upside, and then the 140, 135 verticals to the downside. Could we make money on that? All right, so this is pretty sweet. Okay, so let me, so let's look at that one. That implied volatility is not going to change. We have some time to look at it. But it'll be a good example for tomorrow. All right, good. So BID is bouncing. If somebody can tell me when it makes new highs, that would be awesome. Yeah, it definitely is risky. Now, but let me show you guys something here that you can actually do with this, because this is a play that I actually do. I actually do not like holding through earnings, okay? But here's a play you guys can do, and this is kind of a secret, because it's so easy, I just don't really tell people about it. What you can do is that a lot of times stocks move in you saw the implied volatility, right? It was 100%. What happens, is that implied volatility can go from 30%, okay, up to 110% before earnings. So what you do is you buy, this is where you could buy out of the money calls like a week or two before earnings and just hold on to them, and then sell them just the day, like today, when implied volatility goes to 110. Because what happens in this situation is, first of all, if the stock goes up, you make money on the stock, and the option premium triples on implied volatility. So that's awesome. If the stock goes sideways, okay, the implied volatility triples. Your option actually goes up. If it drifts down, you could actually still get out at break even, because even though the price of the underlying is falling, the implied volatility is skyrocketing. Now, where you lose money, of course, is if the stock just plummets. You're going to lose. But like anything, you manage at a stop loss. But you guys see that you can actually just make money on the implied volatility. And that's a great play, actually, to do into earnings. Okay? All right. Now, the other thing we're going to do here, and by the way, this would be a great one to do for you guys, is do these verticals on CRM tonight in a demo account. If you got Thinkorswim, don't do it in a real account, just because it'll show you, it'll teach you how these options move after an earnings report. Blah, 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 blah. So let's go back here now, and I want to look at CRM on this. Now, if you look at the implied volatility, what's been happening on this? Now, it's not, it's at 60, that's high. It's not at 100 because this is an average. It's like a 20-period average, okay? But you can see, where did it start going up here? It was actually about So about 3 weeks ago. So that's when the implied volatility average really started moving, okay? And you can see it's actually dropped down today. So that means it was probably at 130 or 140% over the last couple of days. So obviously we have no idea what's going to happen after earnings. So you can't make a directional bet that way. But do you guys understand that that's a way to make money into earnings, that you're just actually buying low IV and then selling high IV? Yes, you do have to get into this trade like at least 15 days ahead. This is not a day trade. Now, here's another thing you guys can do. Again, this is not a trade I talk about on my newsletters or anything like that because I really don't want a lot of people doing it. So what you can do here is today is what, May 18th or May 19th? So let's say that, what you want to do is like 3 weeks out, like right here, what you can do is you buy the out-of-the-money puts and you buy the out-of-the-money calls. Okay, what's going to happen? Even if the stock goes sideways, the implied volatility here is going to triple, all right? My iPod is playing Who Let the Dogs Out. Appropriate song. Okay, and the IV here is going to triple. So even if the stock trades sideways, the option premium triples, okay? And it's actually a good strategy is you buy out of the money, or you can buy the out of the money calls, buy the out of the money puts. You do not hold them through earnings. If you get a run this way, great. If you get a run this way, great. You make money on one of them. But even if you go sideways, the point is both option premium will triple in value. And then you can just take both of them off just before earnings. If you understand that concept I just told you, you now understand more about options trading than 90% of the people out there that are trying to trade options. All right. So that's just playing the IV. You can actually go like 2 strikes out of the money. That's fine. All right. So that'll be kind of fascinating. So now, normally what I like to do on situations like this is it's a good directional play. CRM will actually be a good directional play in the morning after earnings as well. And yeah, in terms of today, the only thing you really would want to do today is take advantage of premium decay, but there's not a safe way to do it. Like this is a trade that we should have been in weeks ago. But the nice thing about it is, again, this would be a good one to do like in a demo account tonight, so you can just see how it moves in the morning, and you can see how it impacts the options price. All right. Okay. So, but the good thing with that, the good example of that is, for me, not even knowing that there are earnings tomorrow is looking at this implied volatility going, what the hell is going on here? And then going, okay, something had to go on there. And then compare that to BIDU. And the implied volatility is like 20% or so. Okay, so that's the big difference. So on our 10 calls that we got filled on, it's up a little bit here, but again, we're looking to sell those 135s, and it is at 218. So we still have a little bit of time on that. We'll see if we can get a little rally into the close. Okay. Let me see here what else we got. And I'm just over here looking at my list here. If you guys have any stocks that you want to look at, feel free to type them in. One thing that I was just adding here in radar screen is you can actually sort by implied volatility as well. And if we do that, what does CMG come up as? Because I think that's still the average. I'm curious. AMRN. Oh, they must have. Were they taken? They must have been taken over or something. The easy way to do opinions all the time because it works a lot, and you don't have to like research all this other stuff. But it's fun to find other ones. Now CINA is interesting here because it has pretty high IV here. So we're at 116. The open interest slightly higher at 120, and is very high, and is the highest at 120 on the put side. Okay. That would close. I mean, that's the kind of stock that could do it, right? $5. 20. Most of that upside, to be clear though, is coming still a dollar premium on that. Okay, Brad has a question. So Brad, just a question for you. Have you ever sold naked calls before? Is that what you're talking about doing, just selling the naked calls on it? Okay. Yeah, I mean, I agree that those, the chances of it going there are slim. It's just one of those where, it could have a blowout earnings and it opens up at, 170 and you're hosed. That's the tough thing about it. I mean, okay. Because what happens is that you have literally, something that you sold for 55 cents, now you're buying it back for $20. You just got killed. I like the premium.